If you leave your cash in a standard current account, it earns 0 interest. In a savings account, you might squeeze out 2 or 3%. With inflation running higher than that, any cash sitting idle is actively losing its purchasing power. It is easy to look at stacks of cash and think they are safe, but sitting still is a guaranteed mathematical loss over time. The obvious answer is to invest it. But if you are holding this money for an imminent goal, like a down payment on a house, you cannot risk dropping it into the stock market. You need the exact principal available, without the threat of a sudden market dip. To capture this exact pool of money, the financial industry heavily promotes overnight mutual funds. They advertise annual yields of 6 to 7%, framing them as a safe harbor for short-term cash. Before moving your money, you have to answer 2 practical questions. First, how is an investment generating a 7% yield actually carrying 0 risk? And second, if a medical emergency hits at 2 in the morning, can you actually get your money out? The reality of these funds changes depending on where you buy them. On most popular brokerage apps, you are unknowingly opting into a settlement system that keeps your emergency cash out of reach exactly when you need it most. Earning optimal yield safely requires looking at 2 entirely separate things: how the fund manager actually protects your capital and the specific platform you use to execute the trade. Let's start with safety. When you put money into an overnight mutual fund, the manager does not park it in a standard bank account. Instead, they lend your cash out to major banking institutions for a duration of exactly 1 single night. Banks take these one-night loans to satisfy strict capital requirements enforced by regulators like the RBI. Every day at closing, banks must maintain a minimum cash reserve. If they fall short, they borrow from these funds to bridge the overnight gap. To guarantee they will pay the fund manager back the next morning, the borrowing bank hands over sovereign collateral. Specifically, they transfer government-backed Treasury bills. This exchange is the TREPS cycle, the tri-party repo system. Your cash flows to the bank, and the bank's Treasury bills flow to your fund manager. When morning comes, the transaction reverses. The bank gives the cash back, plus interest, and reclaims their T-bills. Because the collateral is government-backed, the default risk is functionally 0. The fund manager knows exactly what they will earn before the night begins. But this strict safety also caps your returns exactly at the overnight rate. It preserves capital. It does not grow wealth. The underlying asset is safe. But getting your hands on that cash during an emergency depends entirely on where you bought the fund. Your first option is buying the fund through your existing DMAT stockbroker. It takes 3 clicks and keeps all your investments on one screen. But there is a massive catch. DMAT platforms force all mutual fund redemptions into a standard T+1 settlement cycle. If your car breaks down on a Friday night and you hit withdraw, you will not see a single rupee until Monday. Option 2 is skipping the broker entirely. You can register and buy the fund directly on the asset management company's website, like Access or ICICI. Direct accounts operate under a specific regulatory provision, the instant withdrawal limit. By law, AMCs allow you to pull out up to 50,000 rupees instantly, 24 hours a day, bypassing the T+1 delay entirely. However, that limit is a hard cap. If you park 2 lakhs in a direct fund for safety, you can only pull out 50,000 instantly. The remaining 1.5 lakhs is still trapped until the next business day. Direct AMCs give you a true emergency off-ramp, but for most families building a fully funded rainy day account, 50,000 simply isn't enough coverage for a major crisis. If you have a larger emergency fund, there is a third execution option available: aggregated basket platforms, often called small cases. Instead of buying one mutual fund, these platforms bundle 3 or 4 different overnight funds into a single pre-built basket. You make one deposit on the front end, and the platform divides it up. Holding multiple distinct mutual funds lets you stack their instant withdrawal limits. 3 funds mean 3 50,000 limits, giving instant access to 1.5 lakhs. Behind the scenes, the platform routes your cash to separate AMCs, ensuring the limits legally stack. A secondary benefit to these curated baskets is that registered analysts monitor them. If a specific fund manager starts underperforming or changing rules, the basket is automatically rebalanced to drop the bad fund and add a better one. But you trade settlement time for administrative effort. To actually use those instant withdrawals, you cannot just click a button on the small case app.
you will have to manually log in to each individual AMC's website and process 3 separate 50,000 rupee withdrawals. Basket tools successfully solve the liquidity math, but you have to be willing to juggle multiple logins while dealing with an actual real-life emergency. Before making a final decision, you should compare overnight funds to their closest alternative, liquid mutual funds. This comparison matrix breaks down the practical differences. While overnight funds strictly lend cash for one single day, liquid funds buy debt securities that take up to 90 days to mature. This creates a direct trade-off. Because liquid funds lock money up slightly longer, they generally offer a slightly higher yield. But that 90-day window introduces a microscopic amount of interest rate risk that overnight funds simply do not have. Taxes apply to both equally. Neither triggers TDS, but the profits from both are added to your standard income and taxed at your specific slab rate. That means your actual take-home return will be notably lower than the headline yield. The math gives us a clear rule. If you might need the cash in a few days or weeks, use an overnight fund. If you know the cash can sit untouched for 1 to 3 months, a liquid fund is the mathematically superior choice. Who should avoid these entirely? If you are investing on a timeline of 3 to 5 years, stay away. After income taxes, these yields barely match inflation.
They are for preserving cash, not building long-term wealth. For stock market investors who just sold a position and need a place to park cash before buying a new stock, executing through your DMAT account makes perfect sense. The T+1 delay doesn't matter if you're just waiting to buy your next asset. But if you are building an emergency fund, stay off the broker apps. Go direct to an AMC for the instant $50,000 limit, or use a basket tool to string multiple limits together for deeper coverage. Securing your capital isn't a matter of blindly chasing yield. You have to match the execution platform to the real-world reason you are holding the cash in the first place.